For years, we've all looked at Tesla's energy division as this high-growth, maybe even high-risk sibling to the car business. It's always been this fascinating idea, but the big question has always lingered. Is it a truly durable, profitable business? Well, that's the narrative we're going to dig into today because all the latest intelligence is pointing to a massive shift.
So let's just cut right to the chase. The question on every investor's mind, especially right now, is pretty simple. Are we still just betting on some far-off future growth, or is there something much more solid happening right under the surface?
Well, the data is screaming a pretty clear answer. Absolutely not. The narrative has completely flipped. This is not just a growth story anymore. As we're about to lay out, it's a profit story, it's a quality story, and it is happening right now.
First things first, and this is probably the most important piece of the puzzle in today's economy, the AAA Bankability Moat. Because you see, in a world with high interest rates, safe is always gonna beat cheap, every single time.
So what exactly is bankability? Let's break it down. In simple terms, it's how willing a bank is to loan money for a big project. They're asking, is this supplier going to be around in 20 years to service the warranty? When cash is expensive, banks don't take flyers. They bet on sure things. And right now, bankability is the whole ball game.
And this is where the story gets really, really interesting. A brand new report from Solar Media just dropped, and it's a bombshell. They looked at the entire global market, and only 2 companies got their top AAA bankability rating. Just 2, Tesla and Sungrow. That's not me saying it, that's a crucial third-party stamp of approval on their stability and quality.
What this rating does is it essentially splits the market in 2. You've got the AAA club over here, and then you have everyone else. So if you're a developer trying to get a billion-dollar energy project financed, what do? Do you go with the supplier the bank trusts and will actually give you a loan for, or the cheaper guy they won't touch? It's a textbook flight to quality, and it's playing out as we speak.
Okay, so you've got this incredible quality moat, but it gets even better when you start looking at the money side of things. We are now entering what I'm calling a margin supercycle, and it's all being driven by one thing. Costs are crashing while prices are holding firm.
Just get a load of this number. Bloomberg NEF is recording that the core input cost, the battery cells themselves, has hit a record low of $70 per kilowatt hour. Now that's a staggering 45% drop in just 1 year. The floor has literally fallen out on their single biggest expense.
And this chart just lays it out perfectly. You've got your input costs in an absolute freefall. But, and this is key, because of that AAA moat we just talked about, their average selling prices are staying rock solid. And that giant gap opening up between the two, that is pure, unadulterated gross margin expansion. So forget all the talk about margin compression. The data is pointing in the complete opposite direction. We're talking about a clear path to gross margins north of 30%.
All right, so the quality moat is deep, the margins are getting fat, but what if demand dries up? Great question. And that brings us to the third pillar of this whole thesis, the global safety net that really de-risks the entire outlook.
And right on cue, a perfect example just landed. Matrix Renewables just confirmed they're moving forward with a massive 1 gigawatt-hour megapack project in Scotland. This isn't some tiny pilot program, folks. This is a utility-scale beast that proves the demand pipeline in Europe is incredibly strong.
And this Scotland deal isn't just some lucky one-off. It's part of a very clear, very smart global strategy. You pair this with the big deals we've seen in Japan and the glowing validation coming out of Australia, and what you get is a global buffer. If one market has a slow quarter, another one is there to pick up the slack. That's just smart business.
Okay, let's put all the pieces together. We have the bankability moat that locks out competitors, we have the margin supercycle fueled by crashing costs, and we have the global demand that acts as a hedge. So what's the final verdict here?
Well, it seems like Wall Street is finally catching on. A new note from Wedbush that came out this week was pretty telling. They called the energy division the, quote, sole driver of the company's 2026 earnings growth. Think about that. Even while they're trimming their auto forecast, they're holding their price target, all because of what they're calling this recurring revenue moat.
So look, the bottom line is this. The story has changed. This isn't about crossing your fingers and hoping for growth someday. The data is showing us a profitable, durable business with a powerful competitive moat that is generating serious cash right now. It's a flight to quality, not just in the broader market, but inside the Tesla story itself.
And that leaves us all with one final question to think about. In a choppy market with high interest rates, where is capital going to flow? Is it going to chase the illusion of cheap,
Or is it going to find safety in what's proven, what's profitable, and most importantly, what's bankable? It sure looks like the market is making its choice.